This episode, Economic Whirlwind, AI Boom and Sovereign Debt Traps from the Money Construct series, is brought to you by Vizcard Studio.
Welcome back to the deep dive. It feels like the global economy is just sort of holding its breath right now, doesn't it?
It certainly does. Really extreme contradictions. If you look at the data, if you look at the sentiment, we are straddling two completely different worlds.
Right. I mean, on one hand, we are exactly 1 year into this new U.S. administration. We have the One Big Beautiful Bill.
And we have to talk about that name.
Oh, we will. And it's actively reshaping the tax landscape. We have a tech boom that honestly feels like science fiction half the time.
Truly.
We're talking about fusion digital twins, AI embedded in the military command structure. It's, I don't know, feels like the Roaring Twenties all over again in some corners.
But then you flip the page. You look at the international section or, the bond markets, and it's trade wars.
Yeah.
And I don't mean polite disagreements at a summit.
Huh.
I mean 100-year-old style tariff battles. And the fear index, the VIX and its cousins, is hitting levels we just haven't seen since the pandemic, or even worse, the 2008 crash.
It's what the economists in our stack of sources are calling a time of divergent forces. And that's really the theme of what we're going to try and unpack today.
Yeah, that's the perfect phrase for it.
We have a massive stack of documents on the virtual desk reports from the IMF, the MasterCard Economics Institute, the Bank for International Settlements, and policy papers from the White House. And the picture they paint is fascinating, but it's also incredibly messy.
It is. And the core question we want to ask today, the thing we want you to keep in the back of your mind as we go through this, is pretty simple, but also kind of terrifying.
Color.
Are we actually safer now than we were during those last major financial earthquakes? Or have we just, moved the risk to places we can't see as easily?
That is the multi-trillion-dollar question. And to answer it, we can't just look at the headlines from this morning. We actually have to go back in time a little bit.
You have to.
We need to connect the dots backward to the post-2008 reforms to really understand the foundation we're standing on right now in 2026.
Exactly. You can't understand the stability of the skyscraper if you don't look at the bedrock it's built on.
So let's unpack this. We're starting with a report that's actually a few years old, but it acts as our baseline for everything else. It's the IMF analysis titled, "A Decade Later, Are We Safer? Unpacking Global Financial Stability Post-2008."
Right. This report was a retrospective, looking at how the financial system was rebuilt after the global financial crisis.
Yeah.
And to understand 2026, you absolutely have to remember the cliff edge of 2008.
Take us back. What did that fragility look like?
The system back then was just incredibly fragile. Banks were leveraged to the hilt.
Okay, when you say leverage, just for the listener who might not be a banker, paint that picture for us. What does that actually mean?
Sure. Imagine you have $1 in your pocket, but you go to the casino and you bet $30.
Okay, that sounds like a bad idea.
It's a terrible idea. But that was the banking system. They held very little actual capital, their own money, relative to the massive bets they were making on mortgages, on derivatives. So when those bets went sour, they had no cushion. Absolutely none.
It collapsed.
They crashed. And because they were deemed too big to fail, the taxpayer was suddenly on the hook to bail them all out.
I remember that vividly. The anger, the protests, the feeling that the whole game was just rigged. So the mission back then was to fix that. The big question is, did we?
Largely, yes. And this is the good news part of our deep dive. The banking sector today, in 2026, is fundamentally different from what it was in 2008. The reforms, things like the Basel III, Accords force banks to hold much, much more capital.
And what's the specific kind of capital we're talking about?
It's called Common Equity Tier 1 capital, or CET1 for short.
Okay, no jargon, please. What does that actually mean for the bank and for me as a customer?
Think of it as a thicker cushion, or maybe a better analogy is a thicker hull on the ship.
Okay.
It's the highest quality, most loss-absorbing capital. It's the shareholders' money. So if a bank makes bad bets and loses money, it has a much larger pile of its own money to burn through before it collapses and threatens the depositor or the wider system.
So it's the first line of defense.
It's the best line of defense.
Yeah.
And those ratios, the amount they have to hold, improved by 5 percentage points or more in the decade after the crisis.
Yeah.
That's a huge change.
So the banks are buff. They've been working out. They've been drinking their protein shakes.
Exactly. They're much more robust. And it's not just the capital. We have new tools that just didn't exist in 2008. We have living wills for banks.
Living wills, like, if I die, give my stereo to my brother.
Essentially, yes. But for a $1 trillion institution, It's a detailed instruction manual on how to shut the bank down safely if it fails.
Like a controlled demolition plan?
A perfect way to put it. How to sell off parts and wind down operations without blowing up the global economy in the process. We also have rigorous stress testing, where the Fed basically simulates a financial apocalypse.
Fun times at the Fed.
And sees if the banks survive. They model, a huge spike in unemployment, a crash in the housing market, and they check if the bank's capital cushions are thick enough to withstand the shock.
Okay, so we have better hulls, better navigation charts, but the most critical structural change, and this is key for our discussion on 2026, is that the risk was shifted. You said the taxpayer was on the hook in 2008. Who's on the hook now?
Correct. This is maybe the most important part. The risk was shifted from the taxpayer to the shareholders, and to some extent, the bondholders of the bank.
So the investors.
The investors. In 2008, if a bank failed, the government wrote a check from the public purse. Today, the system is designed so that the investors in the bank, the people who own the stock, the people who lent it money, lose their money first.
So that creates discipline.
It introduces market discipline.
Right.
Exactly. If you invest in a bank, you better make sure they aren't being stupid, because the government isn't coming to save your equity. It's your problem now.
Okay, that sounds like mission accomplished. We fixed the banks, we protected the taxpayers. Why is the fear index so high today? Why are we even having this conversation about risk in 2026?
Because of the but contained in that same IMF report. And this is where it gets really interesting for us right now. The report warned, and this was incredibly prescient, that while you can make the bank safer, you can't eliminate the demand for risky financial activity.
Right.
You just squeeze it out of the regulated sector.
Like squeezing a balloon. You squeeze one end and it just bulges out the other.
Precisely. The risk migrated. It moved to what we call shadow banking, or to use the more polite official term, non-bank financial intermediaries, NBFIs.
Shadow banking sounds so much cooler, more menacing.
It does, but it's less mysterious than it sounds. It's hedge funds, private equity, insurance companies, big pension funds.
So huge pools of money.
Huge. And these are entities that lend money and move capital around the globe. But they aren't regulated like banks. They don't have those thick capital cushions we just talked about. They don't have the same oversight. And since 2008, this sector has absolutely exploded in size.
So the risky lending didn't stop. It just moved down the street to a shop with looser rules.
That's a great way to put it. But there's an even bigger flashing red light that was mentioned back then and is now, according to the 2025 BIS annual report, just blazing. It's something called the sovereign bank nexus.
The doom loop.
The doom loop. It sounds incredibly dramatic, but it's a very real, very mechanical flaw in the system.
Okay, what is it?
It's the dangerous symbiotic connection where banks hold massive amounts of their own government's debt.
Okay, walk us through the loop, step by step.
Sure. Step one, the government needs to borrow money, so it sells bonds. Step two, the nation's banks buy up those bonds. They're encouraged to, because government bonds are supposed to be the safest asset in the world, right?
A risk-free asset, they call it.
Exactly. But what if the government's finances start to look a bit shaky, say, because of massive deficits, which, spoiler alert, we have plenty of in 2026? Suddenly, the market gets nervous. The value of those government bonds drops.
And because the banks are holding mountains of them, the bank's own balance sheets take a massive hit. Their value drops.
Right. Step three, now the banks are in trouble. They're technically losing money on their safest asset. So they stop lending to businesses and households to conserve capital.
Which hurts the real economy.
Which hurts the economy. The economy slows down, so tax revenue falls. When tax revenue falls, the government's deficit gets even bigger.
Which makes their bonds drop even further.
And you're back at the start of the loop.
It's a spiral.
It is. It's a terrifying feedback loop where the health of the government and the health of the banks are tied together at the ankle. If one starts to drown, they both drown. And as we'll see when we look at the 2026 data, this nexus has only gotten tighter, more dangerous.
Okay, hold that thought on the doom loop, because that sounds like a central problem for the here and now. Let's look at the landscape right now. We've established the foundation's stronger banks, but risk is hiding in the shadows and in government debt. Now let's look at the house we've built on it. We're looking at the MasterCard Economics Institute's Economic Outlook 2026.
And the theme they've chosen for this year is the adaptive economy.
Adaptive. That sounds optimistic. Like, hey, the house is on fire, but we've adapted to the heat.
It is optimistic in a way. I mean, think about what the world has gone through between, say, 2020 and 2025.
A lot.
A lot is an understatement. We had the pandemic.
Yeah.
We had the complete collapse of global supply chains. We had the energy crisis in Europe. We had major geopolitical conflicts. The argument here is that the global economy didn't break. It bent. It adapted. It rewired itself on the fly.
So what do the macro numbers look like? How are we actually doing?
Global growth is described as resilient. It's at 3.3% according to the latest IMF data.
Which isn't a boom.
It's not a boom, but it's certainly not the deep recession everyone was predicting back in 2023 or 2024. Inflation is cooling, which is the good news. It's projected to fall to 3.8% in 2026 and then 3.4% in 2027.
But 3.8%, I have to stop you there. That's not the 2% we used to aim for. I mean, I remember when central bankers would absolutely panic if inflation even sniffed 2.1%.
No, and that's a key takeaway for everyone listening. The era of 2% inflation is likely over, at least for the foreseeable future.
So this is the new normal.
It seems to be. Inflation is sticky. It's settling at a higher baseline.
Why? What's making it sticky?
Because resilience costs money. Adapting costs money. The old world was optimized for pure efficiency.
The cheapest possible everything.
The cheapest everything, from the cheapest possible place with just-in-time delivery. Now companies are building resilience. If you build 2 factories instead of 1 so you don't get cut off during the next pandemic, that costs money. If you have to pay higher wages to get workers, that costs money. That all feeds into higher baseline prices. We aren't going back to the cheap money, low inflation world of 2015.
Okay, so things are more expensive, but we're growing. But the real story in these macro numbers is the U.S. exception.
The U.S. is pulling away from the pack. It really is. U.S. GDP growth is projected at a pretty strong 2.4% for 2026.
And how does that compare?
Compare that to the euro area, which is struggling at 1.3%, or Japan at roughly 0.7%. The U.S. is running hot, relatively speaking.
And according to our sources, a big driver of that is policy. We have to talk about the elephant in the room. The One Big Beautiful Bill.
Yes, the One Big Beautiful Bill Act, which was signed back in July of 2025.
Can we just pause on the name? I mean, legislation names have gotten creative over the years. The Patriot Act, the CARES Act, but One Big Beautiful Bill.
It's certainly direct branding. You know exactly what they think of their own bill.
It's something.
But whether you agree with the politics or the name, from a purely economic standpoint, this is a massive injection of fiscal stimulus. It's like pouring jet fuel into a car engine. It makes it go faster, but it also might blow up.
What's actually in it? I mean, beyond the catchy name, what is it doing to the economy?
There are a few major levers. First, and this is the most immediate one, are the tax incentives for corporate investment.
Just general tax cuts?
No, it's more specific than that. It's targeting domestic R&D and manufacturing. The message is, if you build the factory in Ohio, if you do the research in Arizona, you get the break.
So it's part of that reshoring, friendshoring trend.
Exactly. And that's fueling a lot of the capital expenditure, the construction boom we're seeing across the country.
Okay, so it's boosting factories. What else?
The other piece, the one getting a lot of attention in the long-term outlooks, is the federal school choice tax credit.
Right, that was codified in the bill. This had been debated for years.
It had, and now it's law.
Right.
It creates a dollar-for-dollar tax credit for donations to scholarship organizations. It essentially federalizes a school choice mechanism.
So it subsidizes private and charter school tuition, basically.
In effect, yes. Now, the full mechanism doesn't kick in until January 2027, so next year, but markets trade on the future. The anticipation of that policy, combined with the corporate tax cuts, has created a very pro-growth sentiment in the U.S. markets.
How so?
Investors see a deregulated, tax-advantaged environment, and they are buying in. They're betting on higher corporate profits and, a different kind of labor force in the long run.
So the U.S. economy is being juiced by this bill, but it's not all sunshine and rainbows. We started this deep dive talking about divergent forces. If the bill is the tailwind, what's the headwind?
Trade fragmentation, in a big way. The return of tariffs.
And not just threats, right? These are actual implemented tariffs.
Oh, yeah. We are seeing protectionism come back in a way we haven't seen since the 1930s. This isn't a small skirmish. It's a fundamental shift in global trade policy.
We have specific numbers here in the report. The U.S. has slapped a 10% global tariff on softwood lumber, which, if you're trying to build a house, is painful.
Very painful.
But the one that jumped out at me is kitchen cabinets.
Kitchen cabinets and vanities, yep.
What's the number on that?
It's a 25% tariff right now, rising to 50% in 2027.
50%! That's massive. So if I'm a listener planning on renovating my kitchen in 2027, I'm potentially paying double for the cabinets, or close to it.
Potentially, yes. Or you're buying a domestic alternative that is now much more expensive than the imports used to be, precisely because the domestic producers have no cheap competition anymore.
So either way, the consumer pays.
This is protectionism in its rawest form. The stated idea is to protect U.S. jobs, but the direct cost is passed straight to the consumer's wallet.
And obviously, the rest of the world isn't just taking this lying down.
No. Trade wars always have two sides.
Hmm.
At least, Canada is specifically mentioned in the source material. They are our biggest trading partner.
And usually our friendliest.
Usually. But right now, Canada is threatening a dollar-for-dollar response.
Meaning what?
Meaning, if we tax $1 billion of their lumber, they'll find $1 billion of our stuff to tax. Our cars, our dairy, our tech exports. If they retaliate, that hits U.S. exporters immediately.
And what about Europe and Asia?
Meanwhile, the EU, Japan, and Korea are all in negotiation mode, trying to lock in a lower 15% rate to avoid the worst of it. But the key thing here is the uncertainty. It's toxic for business planning.
Right. If you're a CEO of a big company, how do you even begin to plan a 5-year strategy when you don't know if your supply chain costs are going to double next month?
You don't. Or you plan for the worst. You hoard cash, you delay investment, or you preemptively raise prices. And that explains the fear index.
The fear index, let's talk about that.
The UNCTAD report we have here notes that the financial fear index, which are measures of volatility like the VIX, it hit its third highest level ever in early 2025.
The third highest ever.
Ever. The only times it was higher were the 2008 crash and the absolute peak of panic at the onset of COVID-19 in 2020.
That is wild. So we have this weird split screen. The stock market is cheering the tax cuts and the tech boom, hitting record highs, while the risk managers and the bond guys are terrified of a global trade war and are bracing for impact.
It's cognitive dissonance on a global scale. Two completely different realities happening at once.
Speaking of the stock market cheering, we have to talk about the engine that seems to be powering all this optimism despite the fear, and that's AI.
The AI Enthusiasm Index, as the MasterCard report calls it.
I love that they actually have an index for enthusiasm. How excited are you today? Oh, about a 7.2. But it's not just hype anymore, is it? We're seeing real, tangible deployment in 2026.
We are. The investment surge is absolutely real. AI-related investment is the primary tailwind that is counteracting the trade headwinds. I would argue that if we didn't have this tech boom, the tariffs might have already tipped us into a global recession.
So the AI spending is masking the damage from the trade war.
It is. The capital spending on data centers, on chips, on software, on implementation, it's just enormous.
The sources gave some wild examples of where this is showing up. And it's not just, writing your emails for you anymore. The Department of War.
Right.
Which, by the way, I still have to get used to. We went from the Department of Defense back to the Department of War.
That was a redesignation that happened a while back, but yes.
Yes.
It signals a shift in national posture, to put it mildly. But look at what they launched, GenAI.mil, in December of 2025.
What is that exactly? Is it just ChatGPT for generals?
Essentially. But it's a secure, walled-off, closed-loop system. It gave 3 million personnel, that's civilians, contractors, military access to powerful AI models.
3 million people.
3 million users overnight. They're using generative AI to accelerate operations, to analyze satellite data in real time, to draft logistics plans for moving troops and supplies, and to speed up decision-making across the entire defense enterprise.
That is a massive scale-up. 3 million users is bigger than the population of some countries.
It is. It's the industrialization of AI in the national security space. And we're seeing it in schools, too, funded by that one big, beautiful bill.
Right. The bill included funding for AI-powered tutoring services,
which ties directly into the school choice credit. The vision being sold is personalized education for every child, driven by an AI tutor that adapts to their specific learning style.
A huge experiment.
A huge experiment. But the example that really struck me, the one that felt like a true sci-fi is now moment, was the fusion energy project.
Oh, the digital twin. Yeah, this was amazing.
Yes, NVIDIA and General Atomics. They created a fully functioning digital twin of a fusion facility.
Explain digital twin for us. It sounds like something out of a movie.
It kind of is. So fusion is incredibly hard because you're trying to contain plasma that is literally hotter than the sun.
Right.
It's chaotic. It's unstable. A digital twin is a perfect virtual replica of a physical reactor that lives inside a supercomputer. They use AI to simulate the plasma behavior inside the computer before they ever turn on the real machine.
So they can crash the simulator 1,000,000 times to learn how to keep the real ones stable.
Exactly. They're running millions of simulations to optimize the magnetic fields, the reactor design, the fuel injection. This is speeding up research in a way human researchers just couldn't. It's collapsing decades of trial and error into months of computation.
It's incredible. It feels like we are on the verge of solving clean, limitless energy. But, and I know with you, there is always a but.
Physics is always the but. You cannot have infinite digital growth in a world of finite physical resources. The BlackRock and Goldman Sachs data points on this are stark.
It's the electricity, isn't it, to run all this?
It's the electricity. These AI data centers are power-hungry beasts. The projections are that they could consume 15% to 20% of total U.S. electricity by 2030.
20%. That is 1/5 of everything, every light bulb, every factory, every toaster in the country.
Yes. That is an enormous, almost unprecedented load on the grid. We are talking about needing to build new power plants. Nuclear, natural gas, solar, whatever, at a rate we haven't seen since the post-war era, just to keep the chatbots running.
So energy is the bottleneck.
Energy is the binding constraint. If we can't build the power plants fast enough to power the chips, the whole boom stops dead in its tracks.
There's another concept in the KPMG report that just blew my mind. We all know offshoring, sending jobs to cheaper countries, and we've heard of nearshoring, bringing them closer to home, like to Mexico. But they used a new term, no-shoring.
This is fascinating, and it's a huge deal. No-shoring basically means the location of the labor no longer matters at all because the labor isn't human.
Wait, unpack that for me.
Okay, think about a call center or a data entry firm or a translation service. For 30 years, companies sent that work to India or the Philippines because labor was cheaper there. That was offshoring.
Right.
But now, if you can use AI agents to do the coding, the customer service, the data analysis, you don't need to send the job to India.
You don't need to bring it to Mexico either.
No, the work isn't done by a person anywhere. You don't need a visa. You don't need an office. You don't need a shipping container. You just spin up a server instance in the cloud. The work happens there, in the ether. It's no shoring.
That changes the entire logic of global trade and development. I mean, if you don't need cheap labor anymore, why would you build a factory in a developing nation?
Exactly. It decouples economic activity from geography in a profound way. For a developing country that was relying on its cheap labor to climb the economic ladder, that is a potential disaster. It kicks the ladder away.
And for workers here?
For a company, it's maximum efficiency. But for the listener, it means your competition isn't a worker in another country anymore. It's a server farm in Oregon.
Which brings us to the financial frontier. We've got AI agents running the back office, fusion reactors in a digital twin, and now, apparently, crypto is finally mature. Is that right?
According to the Grayscale and BlackRock reports we looked at, yes. The language they use is that we have entered the institutional era of crypto.
It's weird to think of Bitcoin as boring, but it sounds like it's becoming a standard button-down part of the system.
It is. Bitcoin and Ethereum ETPs, that's exchange-traded products, are now standard tools in portfolio construction. Pension funds, insurance companies, university endowments. They are holding these assets as part of a diversified portfolio. It's not just for Reddit anymore.
But the really significant regulatory shift in the U.S. was the Genius Act of 2025.
Another great name, the Genius Act. I'm telling you, someone is having fun naming these bills.
They must be.
But yes, the Genius Act established a comprehensive U.S. framework for stablecoins.
And stablecoins are the crypto tokens pegged to the dollar, right? One for one.
Right. They're meant to be the stable transactional layer of the crypto world. Now, traditionally, stablecoins were in a legal gray area, and banks absolutely hated them.
Why?
Because they look and act like unregulated bank deposits. If I put my money in a stablecoin, I'm not putting it in a savings account at JP Morgan. It's a direct competitor.
So what did the Genius Act do to solve that tension?
It tried to find a very clever middle ground. It created a rule. Registered stablecoin issuers cannot pay interest.
Okay, so that protects the banks, right?
Yeah.
If I can't get interest on my digital dollar, I'll just keep my money in a savings account where I get, well, whatever paltry sum the bank pays me.
That was the idea. That was the concession to the banking lobby. But the bill included a loophole, a very specific, very intentional loophole.
Which was?
Issuers can offer marketing rewards.
Marketing rewards? What on earth is that?
There's a reward for loyalty. So you don't get 4% interest on your stablecoin holdings. You get a daily marketing reward for, being a valued member of the platform.
That's the most lawyerly semantic loophole I have ever heard. It's interest by another name.
It effectively functions like yield. And this one little change allows stablecoins to compete directly with bank deposits. And we are seeing the effects. Money market funds are now being tokenized and moving onto the blockchain for 247 liquidity. The actual plumbing of the financial system is being replaced piece by crypto rails.
So banks are facing this new competition from stablecoins. But you mentioned earlier the doom loop and a stark warning from the BIS about what banks are actually doing with their money. Let's circle back to that because it feels like the big dark cloud in this story.
This is the heavy stuff. This is what keeps central bankers up at night. We talked about how the 2008 crisis was caused by banks lending to risky homeowners. Well, the 2025 BIS annual report notes a massive structural shift since then. Financial intermediaries, banks, pension funds are now lending less and less to private businesses for innovation and growth.
So less money for new factories, for R&D, for small businesses.
Less money for the productive private sector economy, yes.
And who are they lending to instead?
Governments. They're buying sovereign bonds. Yeah. Trillions of dollars of them.
Because governments borrowed so much during the pandemic and the subsequent energy crisis.
Exactly. The sovereign debt explosion was massive. Governments everywhere issued trillions in new bonds to pay for stimulus checks, for vaccines, for defense spending. And now the banks and the pension funds are the ones holding all that debt.
So explain the risk again. If the government always pays its bills, what's the problem?
The problem isn't necessarily default. The problem is the valuation. This is the sovereign bank nexus, the doom loop in action. In 2026, the perceived safety of the entire banking system relies entirely on the trust in public institutions and the money they print.
So what happens if that trust wobbles?
Let's say inflation spikes again unexpectedly. What does the central bank have to do?
Have to raise interest rates.
And when interest rates go up, what happens to the market value of all those old bonds that were issued with lower rates?
Their price goes down. No one wants the old 2% bond when they can buy a new 5% bond.
Exactly. Bond yields rise, bond prices fall. So if the banks are holding trillions of dollars in these bonds, and the price of those bonds drops by 10% or 15%, the banks take massive, massive paper losses. On paper, they are insolvent.
It's the exact same mechanic that took down Silicon Valley Bank back in 2023, but on a global, systemic scale.
Precisely. SVB failed because it held too many safe government bonds that lost value when rates went up. Now imagine that happening to every major bank simultaneously. We haven't removed the risk from the system. We've just moved it from subprime mortgages to government treasuries.
That's a sobering thought.
Mortgages can default, and that's bad. But governments aren't supposed to. But when the debt load is this high, the market starts to get very, very nervous about what safe really means.
Wow. Okay, let's pivot from that existential threat to something a little more relatable. The listener, the consumer. How does all this, the AI, the tariffs, the debt, the crypto, how does it all feel to the average person navigating their life in 2026?
The MasterCard data has a great description. It says the consumer is savvy, but value conscious.
Which is code for broke, but trying to make the best of it.
Or at least careful. Very careful. We are seeing a distinct spending shift. Remember those tariffs on kitchen cabinets?
Hard to forget the 50% hike coming our way.
Right. Because durable goods, cars, furniture, appliances are becoming more expensive due to these trade wars, people are pulling back on buying stuff. They aren't buying the new car. They aren't remodeling the kitchen.
So where's the money going?
Instead, they are spending on the experience economy.
Meaning what, exactly?
Travel, live events, concerts, dining out, meaningful moments, as the report puts it.
So I can't afford a new kitchen, but I can afford to go see a concert and post it on Instagram.
Exactly. It's a significant shift away from accumulating goods and toward accumulating services and memories. The logic is, if you can't build assets, you build a life story.
But the labor market underlying that consumer confidence is, you said it earlier, it's churning.
Churning is the perfect word.
What does that look like?
On paper, it looks great. The unemployment rate is low, so the headlines all say jobs market strong. But the type of work is changing at a dizzying speed. We discussed no-shoring and AI agents. Old administrative jobs, entry-level coding, translation, paralegal work, those are disappearing.
So the entry-level rungs of the career ladder are being sawed off.
In many traditional fields, yes. But new categories of jobs are being born. AI prompt engineer was a joke 5 years ago. Now it's a six-figure job. Digital twin maintenance, AI ethics auditor. These are new fields. The AI Enthusiasm Index shows that countries that are adopting AI faster are seeing this churn more intensely. It's happening faster in the US than in Europe, for instance.
So it's a high-stress labor market. You have a job, but you're constantly worried your job description is about to be rewritten by an algorithm.
Correct. It requires a level of constant adaptability that is frankly exhausting for many people. You have to run just to stand still.
Okay, we've surveyed the landscape. We've got the shaky foundation of sovereign debt, the shiny new tower of AI, and the gathering storm clouds of a global trade war. Let's talk about lessons. If I'm a government or if I'm just a person listening to this on my commute, what do I do with all this information?
Let's start with governments. The IMF and the OECD are practically shouting this from the rooftops in their 2026 outlooks. Rebuild fiscal buffers.
Which means, in plain English,
Save money. You cannot run huge deficits forever. During the pandemic, it was necessary evil. But now, with global growth at 3.3%, governments need to stop borrowing and start paying down some of that debt
why is now the critical time?
because they need to reload the gun for the next crisis. Think about it. If another pandemic hits, or a major war starts, or a financial crash happens now, and they are already completely maxed out on their credit card, they have no tools left. They can't bail anyone out if they themselves are broke.
It's like draining your emergency savings account to buy a new TV, and then your car breaks down the next day.
Precisely that. The second big lesson for governments is about industrial policy. Everyone wants to support their own industries now. Chips, EVs, AI. The one big beautiful bill is a prime example of this. But the source is all worn. Be very, very careful.
And they cite the China EV example from a few years back.
Yes. China threw massive subsidies at their electric vehicle industry. And it worked, in a way. It created a world-leading industry, but it also led to massive overcapacity. Far too many firms entered the market, a price war started, quality suffered, and many of them went bust. It was an enormous waste of capital.
So what's the lesson?
The lesson is, any government support or subsidy should be narrowly targeted and time-bound. Don't just throw money at a whole sector and hope for the best. Have a specific goal and an end date.
Okay, and for the listener, for the learner trying to make sense of this,
I think there are three big takeaways. First, adaptability. We've said it a few times, but it's critical. The economy is adaptive, and you must be too. If no shoring is real, you are competing with AI. You need to learn how to leverage those tools, not fight them. Be the person who knows how to run the AI, not the person the AI replaces.
okay, that makes sense. Second,
Diversification. We spent a lot of time on the sovereign bank nexus. The big takeaway there is don't assume government bonds are risk-free anymore. The structural shift in global finance means risk is everywhere, and it's hiding in plain sight. Don't put all your eggs in one basket, even if that basket is stamped U.S. Treasury.
and the third.
Upskilling. But not just in a generic way. Specifically, look at the Manufacturing USA Occupation and Competency Framework that was released in 2025.
That sounds like a riveting read.
It's dry as dust, but it's a treasure map. It tells you exactly where the hiring demand is going to be for the next decade. It highlights the need for skills in robotics, AI integration, and digital twins. It's not just learn to code anymore. It's learn to work with the smart machines that are building the physical world.
Digital twins again. I really need to get myself one of those. Have it do the podcast for me.
We all might need one eventually, just to keep up.
So let's try to wrap this all up. We started this deep dive by asking a simple question. Are we safer than we were in 2008?
And the answer is complicated. It's a yes and a no. We fixed the specific problem of the banks. We made them hold more capital. We stopped the subprime mortgage madness.
What?
But we replaced it with sovereign debt madness. We didn't eliminate the risk. We just transferred it from the private sector's balance sheet to the public sector's balance sheet. We loaded up the governments.
And at the same time, we have these incredible, almost magical tools, AI, fusion, crypto, that promise a golden age of productivity, but we're building walls around them with tariffs and trade fragmentation.
The massive paradox. We have better, faster engines, but we're putting roadblocks all over the highway.
I want to leave the listener with a final thought. We talked about this idea of efficiency versus resilience. For 30 years, the entire world was optimized for maximum efficiency, the cheapest goods, the fastest supply chains, just-in-time everything.
And the lesson of the period from 2020 through 2026 is that we are now paying a resilience premium. We are building redundant factories. We are holding more inventory. We are paying more for secure energy. And all of that costs money. It's the source of that sticky inflation.
But here's the provocative question to end on. In a world of no shoring, high tariffs, and AI warfare, all our systems are being rebuilt to survive shocks, to be resilient. But if the governments themselves are the ones holding all the risk now, if that doom loop is the main vulnerability in the system, What happens when the government is the thing that needs a bailout?
Who bails out the bailout?
Exactly,
Yeah.
bails out the bailout. That is something to chew on as you start your week. Thanks for diving deep with us. We'll see you next time.